Hey everyone, today we'll be talking about a type of mutual fund which is dynamic in nature, which means it can shift between its component based on the current market scenario. These kind of funds are known as balanced advantage funds, and in this video I'll be talking about the what, why and who when it comes to investing in these funds. So when it comes to mutual funds, they can be broadly classified into three types. So first off, we have equity mutual funds. Now, these are funds which majorly invest in the shares of companies, that is, they invest in equity. Then we have debt mutual funds. These are the ones which majorly invest in fixed income securities such as government bonds, corporate bonds, commercial papers, etc. And lastly, we have hybrid mutual funds. These are the ones which invest in equity and debt both, that is, they invest in a combination of equity and debt. So these are the broadly three types of mutual funds that we have. So balanced advantage funds fall under the category of hybrid mutual funds, and this kind of fund has a very important feature, which is it's dynamic in nature, which means it can change the allocation of its money towards debt and equity whenever it's required as per the market scenario. So let's say the stock market is going through a bad time and its valuation falls, which could be due to any reason. So during those times, this particular type of fund would increase its exposure to equity because it's always suggested to buy into equity when its valuation falls, and at the same time it would reduce its exposure to debt. Similarly, when equity or stock market is at an all-time high or it's going through a very bullish phase, these funds would reduce their exposure to equity, that is, they would sell off their exposure in equity and realize the gains, and at the same time they would increase their exposure to debt. So you have the safety of being invested in debt instruments, and at the same time you are able to take advantage of the volatility in the stock market. And these kind of funds have the mandate to increase their equity exposure to as high as 80% when required, and again bring it down to 30%, and the same they can do with debt as well. Now, considering the volatile nature of the stock market, the very fact that these funds can bounce between debt and equity whenever required is one of the primary reasons you should decide to go for these, especially if you're not willing to take too much of risk with equity-oriented mutual funds. Also, it saves you on tax because if you're willing to do this manually, that is, take money out of your equity mutual funds when the market is at an all-time high and then invest those in debt mutual funds and vice versa, you would incur capital gain tax. But in this case, that's not happening because the fund manager within the same mutual fund is doing that on your behalf. And also, when compared to pure debt mutual funds, there is an advantage in taxability as well, because balanced advantage funds are treated as equity mutual funds. So if you redeem your investments within 1 year, it will be treated as short-term capital gains and it will be taxed at the rate of 15%. And if you decide to redeem it after 1 year and your gain amount is more than 1 lakhs, it will be taxed at the rate of 10%. So this taxability structure is much better than what it is with pure debt mutual funds. So if you're not comfortable with taking too much amount of risk with pure equity mutual funds and are considering investing in debt mutual funds, you should definitely consider balanced advantage funds because these are clearly better. And also, you need to give some time for these funds to take advantage from the equity component in their investments. So ideally, you should be looking for a period of at least 3 years if you want to take the advantage from the equity component in this fund. And also, the returns that you would expect from these funds or you would get from these funds would be inconsistent in nature when compared to debt mutual funds, because they can increase their equity exposure to as high as 80%, and during those times you might see some inconsistency, but over a long period of time you'll definitely get to see better returns when compared to debt mutual funds. So that is something which you need to keep in mind if you are deciding to invest in balanced advantage funds. Balanced advantage funds are also very good funds to build the core of your portfolio if you are following the core satellite approach, about which I made a video which you can check out here. And to unravel the magic of compounding, you can check out this video here. So that was it for this video, and until the next one, take care, see you, bye bye.